Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Jonathan Twomley. How you doing, sir?
Doing great, Michael. Thanks. How are you?
Uh, I'm doing awesome, man. So I want to ask a couple questions about the Fed, right? We talked about in video number one, the raising rates, debt going up. We talked about video number two, kind of this pivot investors need to have because again, there's been a sea change according to Howard Marks, which we both agree with. But now I want to go back to really what's called the dot plot or the 19 Fed presidents talking about their opinions of 2023. And I actually told my audience to pay attention to these a few days ago, and we talked about it this morning, but I want to go through it with you. The first one that was interesting to me was the terminal rate, right? Which, how high does the Fed think they're going to have to go before they pause? Last, 2 meetings ago, 4.6. To me, the decision this week was does that average go above or stay below 5%? And I don't know if you saw it, but it came in at 5.1,
Hmm.
which means the Fed's gonna, basically hit us with 75 basis points more, right? They want to go between 5 and 5.25. Um, A, did you see that? And B, what do you think that really means going forward?
I'm sorry. The second question, what do I think it means? What does that question mean?
Well, yeah. So first off, so for example, to me, it means they're going to hit us with 25s going forward, right?
Okay.
The supersize moves are done, right? 75, 50, done. Any moves forward are going to be a quarter. They're likely going to be in the first half of next year, not the later. Because again, they're not saying 6.25, which means we've got 5 rate hikes ahead of us, right? It's 3. And then the last thing is, again, these 19 individuals are no better than you or I at predicting the future, right? They're humans. They may have access to more data than us, but they're not better per se. And they could always back it up, right? Maybe they've been low, now maybe they're high, and next time they bring it down. What do you think?
Well, I think they're going to keep on raising, and I think they're going to. And I'm not sure that they're going to stop necessarily at 75 additional basis points because they're kind of iterating every month. I mean, they're looking at the
Yeah,
data to go
as
right.
they should.
So, as they should. So I think that they'll continue to monitor the inflation numbers and see where they are. But that Howard Marks
Mhm.
blog post, the sea change, one of the I really encourage you guys to read this, and Michael, hopefully you can post it in the show
Sure,
notes
I could do
today.
that.
But it's kind of a long article, but it's really worth your time to read it.
Hmm.
And one of the many like tidbits in this article is how he believes that the Fed will continue to raise rates until real interest rates are positive. And I thought that that was really interesting because he said even now, their real interest rates are still negative 2.5%.
Yeah. So what is it? What he means by that is inflation is 7%. 10-year note is, I don't know, call it 3.5. Hence,
Yeah,
real interest rates are negative. That's what
yeah.
that means.
So the short, I think is they do it on the short term
Okay.
interest rate.
Yeah.
So whatever, so the short term interest rate is around 5% or something,
Okay.
and so the basically you subtract the interest rate from inflation, and what you get is the real interest rate,
Which is a
right? And
negative
so
number. Yep.
which is a negative number, or the other way around. You subtract inflation from the interest rate, and you get whatever you
Mhm.
get. So he said he thinks that they will continue to raise. Frankly, this implies a lot more interest rate hikes. But he said they want to. Well, I guess if they tame inflation, then it changes
Comes
the number.
down, right? Yeah.
Yeah. So, but he said basically they're targeting 2 to 4% real interest rates, right?
Ooh, 2 to 4.
So,
Oh
yeah. Well,
wow.
which so that may sound like if they get back to 2% inflation, that means you're talking about an interest rate between 4 and 6%, right? Which is
Yeah,
historically
that's not crazy.
not bad,
Yeah.
right?
Yeah.
I mean, I remember when my dad got super excited about interest rates going down to 6%, right? So he could refinance his mortgage, and he was really happy about that. So historically speaking, those are normal interest rates. And he also said that they are pushing to, and he believes they should get up to normal interest rates because it's better for the economy and better for investors, and it's means that they have room to cut if they need to, if there is a big recession, right?
Yeah.
So,
Yeah.
and right now, for people who are, uh, you know, with one, with one half of their brain scared of a recession, and with the other half of their brain hoping for one because they think the Fed is going to cut rates, um, like no dice. I mean, what he said was it's going to have to be a severe recession
Yeah.
for them to cut rates because of a whole bunch of factors, not the least of which is credibility and other things. But then another thing that he mentioned in this article, which I thought was interesting, was that, and you have mentioned this before, so credit to you. He talked about not just the inflation rate, but the psychology of inflation, right? And that one of the things that the Fed is trying to do is not just tame the inflation rate, but get rid of inflation in the minds of
inflation expectations. Yeah.
So that, and that was the big problem in the 70s, was that
Oh
people,
yeah.
because inflation had been a problem for a long time, right? Really, the whole 60s and 70s there had been pretty strong inflation, and then in the late 70s it just went wild, but because of the oil crisis. But the people just came to expect it, and
Yes.
and then the opposite happened, where people stopped expecting it for the Great Moderation, but now suddenly they're expecting it again. And the Fed, one of the reasons why they've acted so dramatically is because they don't want that inflation expectation to start getting baked into people's thinking.
Agreed.
So they have to be really aggressive and get inflation back down to 2% to basically stop that in its tracks. So I think we're just going to continue to see raises. I think it could easily go past 75 basis points.
Okay. Yeah.
So
Yeah. So there's two more things to talk about. The next one for me, this is certainly not Powell's words, but it kind of translates, in my opinion, to stagflation. What do I mean by that? He basically said the 19 Fed presidents who were part of the dot plot said GDP for 2023 will be 0.5%.
Yeah.
If you have 0.5% GDP in an environment where inflation's 4 or 5%, I don't know if that meets the technical definition of stagflation, but it certainly feels like stagflation to me. What do you think?
Well, yeah, I guess on that basis it is, but also when you describe it that way, it sounds a lot better than a recession. So
yeah, exactly. Yeah. That was Powell's answer. It's still positive.
Yeah. I mean, growth is growth, right? So
that's what he said. It's exactly what he said.
So, I mean, I think people talk about stagflation, and I think it's normal. Like there's sort of the one example of stagflation, and then it's really bad, and then they all think, well, that's where we're going. And there's some arguments that said, yeah. But look, if we have stagflation for 2 quarters, right? Like, will anybody notice? Like, will anybody care? And I think there's a lot of structural differences in the economy between then and now. And again, going back to this Howard Marks article, which you really got to read, another just fascinating tidbit that it's one of those things I sort of knew about, but I never really understood the implications of it. In the 70s, right, the workforce was much more heavily unionized than it is now. Yes. And the union contracts had cost of living increases built into them. So every time inflation went up, it caused wages to automatically go up, and then that caused inflation to go up, and it was like this cycle that we couldn't get out of, right? Yeah, we don't have that anymore, right? So the whatever you're seeing from wage inflation right now is just purely market driven. It is just supply and demand. It is not automatically baked in lockstep cost of living increases in wages, which are crippling. So, and that was a big contributor to stagflation, right? Was because there was no additional worker productivity that was coming along with the wage increases. It was just going in lockstep with the cost of living. Therefore, you had literally stagflation. The economy was not getting better, but you had inflation, right? So we don't have that anymore. So I think if we do have stagflation, it'll be kind of nominal stagflation, like you just described, and it's not going to be pernicious.
It's not going to be the horrible. Yeah, I agree. Yeah. And then the final one to talk about was unemployment. This is the one that I was really paying attention to, because again, you hear the Fed, you hear about tight job market, you hear about this, you hear about that. We're at 3.7. I was actually surprised that they saw a peak unemployment rate next year of only 4.6. Right, given all the tightening, given what they said is coming, higher, slower, longer. I don't think 4.6 gets the job done. Right, if it feels horrible to say, that's millions of people losing their job, but I think if we only get to 4.5, 4.6, it just means inflation is a problem longer. I don't know. So I 4.6 doesn't feel high enough to me.
Well, I guess it also, I mean, and I'm just speaking to this blindly because I haven't looked at the data. I'm just speculating. It also, like, the labor participation rate also matters here, and we don't know what
Sure.
that is, right? Because
Well, they didn't. Yeah, they didn't estimate it. Right now, it took last reading took tick down to 62.1.
well,
And on it's
that could
low.
be it. That could, you could have essentially like hidden unemployment, right?
You-
Because even though if the nominal rate of unemployment is 4.6%, if the labor participation rate has declined, they're
Yeah,
just not counting those additional people in the rate
correct.
because they're quote unquote not looking for work, right? So that maybe that's why.
Maybe
So like a real, remember back in COVID when we were talking about the U6 versus
real
the
and yes, you
U3?
too.
Yeah.
Yeah, yeah,
So
yeah, yeah.
it might be kind of time to look at that data again and
Okay.
see,
Yeah, I'll take a look. Yeah.
yeah, what the real unemployment rate is, and maybe that's where it's coming in.
Yeah, yeah. Basically, if we have enough of a recession, what you're saying, and probably right, I'll need to look at is people just come off the sidelines, right? U3 doesn't count the not interested, U6 does. So yeah,
Yeah.
maybe there's some hidden employment there, maybe.
And I
Yeah.
think also, I mean, one thing we haven't talked about for a while is just demographics, right? And we do
Aging
have
population and that. Yeah.
baby boomers are retiring every day, right? And uh, frankly, high stock market valuations and high house
Yeah.
prices encourage them
Sure. They were
to
set
retire. Yeah, which I mean, you may be seeing some of them come back into the labor force because they have
for
to.
sure. Yeah,
But
could happen.
that's we still do. When you were talking about Ivy Zellman
Mhm.
and her ideas about whether the housing market really is as strong as it's purported to be, a large part of her argument is based on demographics, and so that's also behind the labor participation rate, right?
You're
So
right. Yeah, you need to look into that. Well, Jonathan, this is always fun talking to you each week. Where can people find you?
yeah, come and join my Facebook group, Apartment Investors Club.
Yeah.
Just come and join us. There's free videos. There's lots of material. There's a good conversation in there for you. And if you want to join my email list, there's a free download that you get if you go to apartmentinvestorsclub.com. So go download that. You'll get on my email list and you'll see all the stuff that I'm getting up
Yep.
to, including a conference in April. So look at,
Woohoo!
yes.
Very cool. Well, Jonathan, you have an amazing week. Thanks, buddy.
Thanks. You too.
Mhm.